Hello, everyone. Welcome to the Dorsey Wright Monday Analyst Discussion for this Monday, November 23rd. My name is Ian Saunders, and joining us here today as well as Will Gibson. And Will, we're coming in here this week to a holiday week, coming in with the market being closed there on Thursday in observance of the Thanksgiving holiday here in the U.S. So a slightly abbreviated week with a half day, that I believe, on Friday as well. So not as much going on to kick off the week, I think, as we'll be actually having a piece come out in our daily equity report a little bit later on today that looks at how we typically see less volatility and less volume in the market on those holiday weeks with those market holidays as we enter in this holiday season here. Definitely more to come on that. And certainly there are going to be years that there are outliers. I think everyone remembers Christmas Eve of 2018, but nonetheless, coming in this morning to relatively muted market movement across the markets. And if we look back over the course of movement over the past 7 days in our weekly performance review of these major kind of market funds that we've continued to update on a weekly basis over the past several weeks, definitely a continuation of that laggard theme that we saw across the market last week, with energy surprisingly being the top performing sector, with that Energy Select Sector Spider Fund, their ticker XLE, showing a 7-day trailing return of over 5%, almost 6% there at 5.7% return. Pretty significant 30-day performance as well, up over 20% at a performance of 22% on a trailing 30-day basis there through Friday, November 20th. But as we can see, that definitely would be classified still as a laggard area, given its year-to-date and one-year trailing return, which each are about 40% losses over those respective timeframes. As crude oil coming in right beneath that, unsurprisingly, they're seeing the strength or near-term strength in both of those areas. And then we get into kind of an interesting few funds that we see next, showing major outperformance from small caps, continuing with that kind of laggard strength that we've gotten throughout much of November now. But then still seeing some of those areas that have shown leadership throughout the market over the past several weeks continue to demonstrate strength with positive returns, such as that momentum sector ETF representative there, the First Trust Dorsey Wright Focus 5 ETF, up over 2% on a trailing 7-day time frame, and making a new all-time high, actually, which we'll get into here in just a second. But we see a pretty broad representation from many different areas of equities showing positive returns last week, with international equities also showing strength, with EEM and EFA each up over 1% there over the course of the past 7 days. And some other sectors that have shown strength and others that haven't, such as materials, industrial, and financials. Industrials being that area that has kind of continued to demonstrate strength over the past few weeks. Materials and financials have lagged a little bit, but continue to show outperformance there. So definitely kind of an interesting breakdown from the major market representative funds that we have here, leading us into what is historically a pretty low volume week. And we're seeing a little bit of this kind of laggard conversation continue, at least with market movement at the time of this recording on Monday. But that laggard outperformance hasn't quite carried over to show underperformance from some of the higher momentum or those relative strength focused areas.
Yeah, Ian, that's right. And as you mentioned, specifically that First Trust Dorsey Wright Focus 5 ETF, it tracks an underlying model on the platform, also called the Focus 5 model. You mentioned it's hit an all-time chart high as it has, and it's also trading on 3 consecutive buy signals on its default point and figure chart. One more point that I want to make about this, as we were talking about earlier, is that this may not look like a chart that is sitting at an all-time high like many other charts have that are high on stems, distant from support. Visually, that is not the case here. We do have stair-stepped support working its way down, beginning at 35.50, next at 34 flat, and then down to 32.50. So we do have incremental and close levels of support while at all-time highs. So visually, a positive sign for us to see. We also note that the Focus 5 strategy, as it is right now, is carrying a 5.49 fund score. So ranging from 0 being the worst, 6 to being the best. This is for an ETF or mutual fund with a score of 5.49. That is extremely high and very favorable from our technical perspective. So all positive on that front. Something else maybe to go a bit deeper into the strategy is to note its sector allocation. So as Ian was stating, we have had a bit of a laggard outperformance the past week plus, going on 2 weeks of market action, where your early darlings like technology have not by and large kept up with the laggards or the areas that got beat up on the year. Again, energy, namely one of them. And the Focus 5 model, however, note that it's still heavy in technology. It's overweight technology, industrials, and consumer cyclical. And of those 3 sectors, one that we want to add one more point on is the industrial sector. So while we've observed a lot of the laggards outperform the high momentum areas, note the high momentum areas haven't necessarily been negative. They've still been making new highs, as evident here and across the market, but they haven't performed as well per se as those laggards. However, I think the industrial sector is an exemption there because that has been a high momentum area, and we've seen that continue to push higher. Subsectors, if you want to look, machinery and tools have been very strong. A lot of new all-time highs coming from that subsector in the industrial space. Fair amount of qualitative tailwinds there as well. But by and large, strategy capturing that momentum, still doing well despite some of that laggard near-term outperformance. And one thing I do want to tack on just the end here, as I was mentioning and hearing Ian, you talk about a few of those kind of performance trends. On the day right now, I was just looking, and the 20 best performing year-to-date stocks in the S&P 500 are about flat, whereas the 20 worst performing year-to-date stocks in the S&P 500 are up about 6% right now. So fair amount of spread. And then of those 20 best performers today, 13 are in the energy sector, but guess who's second? And that is the industrial space. So just a few neat points, Ian, before I get too distracted. Let us carry on here.
No, absolutely. No distraction at all. I mean, in thinking about that, it does kind of make sense, right? We're continuing to see those areas that have kind of underperformed throughout most of the year kind of pick up the pace a little bit here in what is that lower volume week, with showing that significant outperformance continued from energy there. And then industrials as well, like you said. I mean, it's been an area that hasn't been out of favor. I mean, it moved in here as a model holding. It's taken up a fifth of the model now. Keep in mind that the Focus 5 model seeks to hold five sector ETFs, so 3 of those being technology, but one of those being industrial, and definitely contributing to that continued outperformance that helped print those new all-time highs there last week at 37.50. And another space that has shown a kind of continuation of the upside of momentum, though, is small caps. I mean, the small cap conversation has been one that has been in the news much more frequently recently, right? And large caps as a whole were those that was the size and style kind of breakdown of the market that held up the best during the market decline that we saw in the first quarter, and then led the market out of that hole pretty much, showing this kind of significant outperformance over other size breakdowns throughout most of the year after that March decline. But over the past few weeks, as we've continued to touch on both in these videos, the podcast, and the written research, we've continued to see outperformance from the small cap space, but significantly high outperformance from momentum areas within small cap, those kind of small cap growth oriented areas, and especially those areas with a momentum focus, such as the Invesco DWA Small Cap Momentum ETF, ticker DWAS. Which again is a fund that we run in there with Invesco. The fund seeks to track an index called the Small Cap Technical Leaders Index, which is essentially seeking to hold the top 200 momentum scoring names from the broader small cap space within the U.S. markets. And we've seen that those areas have led to pretty consistent outperformance, with the fund moving higher intraday this morning to actually print its 10th consecutive buy signal up there at a price value of 69, and printing that new multi-year high that we see depicted on the chart too. Not quite a new all-time high here for this ticker DWAS. Saw that high printed actually back in August of 2018. So still has a bit to go before we get back up to those price levels there, but definitely significant outperformance, moving to a positive trend there in May, continuing to print those consecutive buy signals. And like Will said with FB, the nice thing about some of this stair-step approach is that we get those pretty near-term support levels that are offered. Not quite as frequent support as we saw with the sector rotation strategy FV, but we still get near-term support offered here at 64 on the default chart of DWAS, as well as support offered down at 59, and then down to the 56, 55 range as well, down towards the bottom of that trading band. Coming in here as well, we see that DWAS has a strong fund score of 5.56. So again, as Will said, that fund score ranging from 0 to 6, with 6 being the best. So getting pretty high up there from a fund score perspective, and the higher the better, as we like to say in that fund score methodology. And we've actually recently, over the past week or two, seen the small cap growth group move into the top position on the broader asset class group scores page out of all those 135 different investable areas of the market that we track from a scoring perspective. Seeing small cap growth overtake its mid and large cap counterparts to get to the top of those score rankings. And then we have this fund here with DWS scoring over full half a point higher than that broad average score for U.S. small cap growth. So seeing that kind of continued strength from the momentum aspect has some potential support that's offered there on a near-term basis, but printing that 10th consecutive buy signals definitely kind of furthers the confirmation that we're seeing from the small cap growth space there, Will.
Yeah, absolutely, Ian. And I think, as you stated, I also think about the 10th consecutive buy signal. You don't hear that very often. And as you also said, I mean, small cap growth, no question, there's a fair amount of strength and demand in the space right now. It is atop the asset class group scores page. What we're showing here is all the what we call blue sky zone. So all the groups that are above that optimal 4.0 average fund score threshold. And small cap growth is at the very top, number one rank, 4.93 average score, strong score direction of 1.5. Also note that it is nearing a bit frothy territory as we see an elevated overbought, oversold reading, just looking and telling us that the current price is maybe a bit distant from mean or normalized trading levels. And we can also spot that in a few other groups. A few that I will mention is the Asia group is actually doing extremely well, ranked 7th out of all groups on the platform. And then along with micro caps and then all small caps. So not just the small cap growth, but we've seen a lot of participation. Small value we've written on lately has experienced a fair amount of upside in recent weeks as well, also contributing to a bit maybe near-term overextension on some of those charts, not all of them, but some of those charts we have seen a fair amount of froth enter the marketplace. And one more thing, I mean, maybe from an asset allocation perspective, this would say there's empirical evidence that you have reason to maybe step down or work down some of the size ladder. So if you were heavy overweight, large cap growth, you now have some reason or backing to begin to add some exposure to smaller styles, smalls and mids, diversifying away that pure large cap exposure. I do want to reiterate, though, large cap growth is still ranked 10th out of all groups, still has a positive score direction, strong optimal fund score of 4.65, and is really at moderate trading level. So not statistically overextended from what we would say. So a lot of participation. On that participation and breadth, as we'll call it, we can also see that in the ranks. If you're watching on the left-hand side here, we have money market and equity core. So money market is telling us where cash ranks as a percentage versus all groups on our platform. That's down at 2% right now. And Ian and I were talking before here, and that's generally about the lowest level that we'll see money market reach. And then on the other side, we see an equity core at about 91% or 90%, saying that we still have a very equity dominant and strong market, but it's not as hot as it used to be. That S&P 500 funds group a couple months ago, I remember, was up higher in the 90th percentile, pretty warm, as we would say. That's not the case now. This is by and large healthy, signifying strong core. And the money market group, you're wondering, if it's low, is that an ominous sign? By our indications, not so much. That's just telling us that we're seeing more participation from the bottom, not so much or underperformance from the top. So those really weak groups that were scoring worse than cash have now risen above, signifying that market participation. So Ian, really continuing the theme, fair amount of strength for small caps, mids, momentum still doing well, and by and large, a lot more breadth across the marketplace.
Yeah, absolutely. Well, and I think that point you touched on there with looking at the percentile ranks is pretty significant. Like you said, I mean, we have the money market percentile rank down at 2% is may seem surprising, right? To see, okay, well, it's all the way down at 2%. I mean, that seems pretty low. Must be snapping back soon, right? But I mean, like you said, if we look back historically throughout that score history, 2% is down right around where we kind of see that lowest level typically sit, but it has definitely remained at very low field position for prolonged periods of time in the past. And seeing that continued outperformance from some of these other equity-focused areas up at the top, while still maintaining a relatively high position from the core equity percent rank can certainly be viewed as a positive sign as we head towards the end of the year here. We see this kind of theme continue, the outperformance from those risk-on oriented areas and the continued dampening of those risk-off oriented areas furthered in the DALI page, Dynamic Asset Level Investing rankings as well, looking at the broad asset class breakdown. So again, 6 broad asset classes that we're taking a look at from a relative strength perspective on this page. We saw domestic equities move back into the top end of these rankings in late August, and it's continued to distance itself from the other members of the field over the past several weeks here, over the past week especially, moving back above the buy signal tally count of 300 signals to its current position at 314, breaking above that 300 level for the first time since volatility ensued there in the first quarter. So still seeing that continued follow through from domestic equities after it retook that number one position. And on the risk off side, cash and fixed income continue to decline in buy signals. International equities has continued to pick up buy signals, leading it back into the top 3 and furthering itself to close that kind of gap between itself and fixed income, which still ranks in second place. But the nice thing to note on this from looking again at the weekly buy signal breakdown over the past several weeks, that fixed income and cash both continuing to lose buy signals over the past few weeks. International equities picking up a significant amount of buy signals, bringing it close to that fixed income. So that'll be the next kind of relationship to monitor as we see this kind of broader global equity strength. We see this continued with the breadth that we're seeing over the past week to see if those two asset classes can get any closer to see about international equities moving back into the second position there. So that'll definitely be one area to keep an eye out here, Will, as we look to see if this breadth is going to be continued as we head towards the end of the year.
Yeah, Ian, definitely something to keep mind of. We've hit on a lot of positives today, not to mention there's always going to be some rip currents taking place underneath the surface. So as we head into year end, make sure your alerts are tuned up, and also know that you're always welcome to contact us, whether phone 804-320-8511 or via email dwa@dorseyright.com, where we're very responsive to both of those. And don't think that you're bothering us. We enjoy this stuff. Ian and I like talking about this. So we're happy to share that and happy to help where we can. So all that said, Ian, thanks for having me on this week. Thank you to you all for listening. If you're celebrating Thanksgiving in the United States, we hope it's a safe and enjoyable holiday. And we will talk to you all next week.